Warren Buffett, the man worth over $130 billion, once sat on over $180 billion in cash while the stock market was hitting all-time highs. People called him out of touch. They said he'd lost his edge. Financial Twitter roasted him. And then? The market corrected. And Buffett went shopping. This is not a coincidence. This is a strategy, one he's used for over 60 years to become the greatest investor of all time. Today, we're breaking down exactly what Warren Buffett does when he thinks stocks are overvalued, and what you can take from it. Before we talk about what he does, we need to understand how Buffett knows the market is overvalued. He doesn't use fancy algorithms. He doesn't watch CNBC. He has a few simple tools. Tool number 1, the Buffett Indicator. This is the ratio of total U.S. stock market capitalization to GDP. Buffett once called it probably the best single measure of where valuations stand at any given moment. When this number is well above 100%, say 150%, 180%, 200%, Buffett gets cautious. When it's low, he gets excited. Tool number 2, the 10-year Treasury yield. Buffett views interest rates as gravity for stock prices. When rates are high, future earnings are worth less today. So when yields rise and stock prices don't fall? Red flag. Tool number 3, his own gut, based on price versus intrinsic value. He calculates what a business is actually worth based on future cash flows, then compares that to what the market is charging for it. If the gap is too small, or inverted, he walks away. Here's the move that confuses most people: Buffett does nothing. Well, not exactly nothing. He builds cash. At Berkshire Hathaway, when Buffett can't find anything worth buying at a reasonable price, he just lets cash pile up. By early 2024, Berkshire's cash reserves had surpassed $160 billion. By mid-2024, it was pushing $180 billion. That's not laziness. That's discipline. Most retail investors panic when they're sitting in cash. They feel like they're missing out. But Buffett sees cash differently. He sees it as optionality. It's the ability to strike when everyone else is forced to sell. He's said it himself. We don't get paid for activity. We get paid for being right. Think of it like being a hunter. Most investors are out there shooting at anything that moves. Buffett is sitting quietly in a blind, waiting for the perfect shot. Now here's something people really don't expect from the buy and hold king. Buffett sells when valuations get absurd. In 2024, Berkshire massively trimmed its position in Apple, one of its most beloved holdings, reducing it by nearly 50%. This shocked Wall Street. But Buffett's reasoning was classic Buffett. Apple had become so large a portion of the portfolio, and had run up so much in price, that it made sense to lock in gains, especially with capital gains taxes potentially rising. He also famously sold a huge chunk of Bank of America stock in 2024, raising billions. This isn't panic selling. It's rebalancing based on price, not fear. The lesson? Even Buffett's favorite stocks have a price at which he's willing to sell. No stock is a hold forever no matter what. The fundamentals have to justify the price. When they don't, even Buffett takes chips off the table. Here's a move most people completely overlook. Berkshire buys back its own shares. When Buffett can't find great businesses at fair prices in the open market, he turns inward. He looks at Berkshire Hathaway itself and asks, is this stock undervalued? In 2020, 2021, and again in recent years, Berkshire repurchased tens of billions of its own stock. Why does this matter to you? Because it signals something. When Buffett buys back Berkshire shares, he's essentially saying, I can't find anything better to buy than our own business. It also increases the value of every remaining share, which benefits long-term shareholders directly. For individual investors, the lesson is this: when the whole market looks expensive, look closer to home. Your own company's stock, your own business, reinvesting in your own skills and career. Sometimes the best investment isn't on Wall Street. Most people think of Buffett as a strictly American investor. But when US stocks get expensive? He looks overseas. In 2020, Berkshire quietly built up massive stakes in 5 Japanese trading companies: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. By 2023, he was flying to Tokyo personally to meet with their management and announce he was increasing those positions. These companies were trading at low price-to-earnings ratios, paying solid dividends, and operating businesses Buffett understood: commodities, trading, energy. The move paid off enormously. The lesson? Buffett doesn't have country loyalty when it comes to investing. He follows value, wherever it lives. If US stocks are overpriced, maybe European stocks aren't. Maybe emerging markets have hidden gems. Maybe Japan, like it did for Buffett, offers the opportunity the US market no longer does. Here's the thing about all of these tactical moves: the cash hoarding, the selective selling, the buybacks, the international diversification. They all come from the same philosophical foundation. Buffett's mentor, Benjamin Graham, taught him one idea that has never left him. Price is what you pay. Value is what you get. When prices exceed value by a wide margin, that's when Buffett pulls back. Not because he's scared of the market. Not because he's predicting a crash. But because the math no longer works in his favor. He's also said something that most investors forget during bull markets. Be fearful when others are greedy, and greedy when others are fearful. Right now, whatever market you're operating in, ask yourself, is the crowd greedy or fearful? Because wherever the crowd is, Buffett is probably on the other side of that trade. Okay, so what do you actually do with all of this? Here's a quick cheat sheet. 1. Don't feel pressured to be fully invested all the time. Cash is a position. Holding it while waiting for opportunity isn't weakness. It's strategy. 2. Check your concentration. If one stock has run up and now represents 40% of your portfolio, it might be time to trim, just like Buffett did with Apple. 3. Look at valuations before you buy. Use simple tools. P ratios. Price to book. Compare to historical averages. If something's trading at 60x earnings with mediocre growth, you're paying for perfection, and markets rarely deliver perfection. 4. Don't be afraid to look internationally. There are solid businesses with real earnings trading at reasonable prices outside the US market. 5. And most importantly, have a philosophy. Know why you're buying something. Because when the market goes sideways, and it always does eventually, your philosophy is the only thing that keeps you from making emotional decisions. Warren Buffett isn't magic. He's not smarter than every analyst on Wall Street. What he is disciplined. Consistently. For 6 decades. The market will always have periods where everything looks expensive. What separates the great investors from the rest isn't some secret formula. It's the ability to wait, to stay rational, and to act decisively when the time is right. If this video gave you even one idea to think about, hit that like button. It genuinely helps the channel grow. Subscribe if you want more breakdowns like this. And drop a comment. What do you do when stocks look overvalued? I read every single one. See you in the next one.